Benji Haya spoke with Daniel Leigh, head of the IMF's World Economic Studies Division. He discussed the key risks facing nations and what needs to be done to address them.
The advanced economies are the ones leading the slowdown. 93% of advanced countries have got slower growth this year than next year. We've got growth falling from 2.7 to 1.5% for advanced economies. Some of them, such as Germany, even have negative growth. The emerging market and developing countries have got more stable growth, 4%. 4% next year. So it's a very divergent the situation, with the differences and contrasts across regions.
Growth declining, but inflation is set to be above target in 2023 for 96% of economies with targets. Is global inflation falling at the expected rate?
Yes, inflation is falling even slightly faster than we thought at the global average level, from 8.7% in 2022 to 6.8% this year. And we've revised it down slightly on account of China, which is a fifth of the world economy. They've got inflation actually below target. So it's true that 96% of countries are above target, but China is an exception to that. It's going to continue next year in our forecasts, this decline in global inflation, but it won't be until 2026 that inflation is close to target again.
When you speak about inflation, you can't ignore the role of central banks and interest rates. Of course, there's the Federal Reserve decision on Wednesday. We're seeing central banks in China, though, cutting rates, and others in Southeast Asia taking different sorts of paths given their lower inflation. What is the IMF's recommended course for central banks in terms of tackling inflation?
Right. So our sense is that the central bank tightening that is coming is what's needed, and it's important to stay the course until inflation is really durably back to target, because there's been cases in the history where central banks have let up the fight too soon, only to see expectations sort of normalize at above target levels, and then it's much harder to fight it later on.
I'm reading here that adverse risks have receded, but the balance of risks to growth remain tilted to the downside. What are the main challenges that the global economy is going to face in the coming year?
One of the main challenges is inflation. It could be stickier than expected, and then we'd have to have tighter rates, cooling housing markets, and slowing growth even more than we expect. Another one is China. China's rebounding this year from last year's very slow growth, but the real estate sector poses a risk, and if that materializes, then we'd have a negative effect on a lot of other countries. Debt is very much a source of concern, especially in lower income countries, and the lower growth and the higher interest rates mean that several of them, actually more than half, are close to default or already in debt distress. So there's a lot of risks, mostly to the downside, unfortunately.
Let's talk about one or two of them. The concerns over rising corporate debt in Asia because of those higher interest rates. How problematic is that, and what sort of resolutions are there?
Right. So in Asia, the corporate debt and leverage was already rising before the pandemic, right? But now, with the slower growth and the higher rates, that's becoming more and more concentrated in sectors where companies are at high insolvency risk. And so this is a pocket of vulnerability. Now, we do see that the banking sector are well capitalized in Asia. So if they take losses from these companies potentially defaulting, they should be able to absorb that. But it's reason for the financial supervisors to be vigilant. One of the issues that people talk about is debt sustainability for the countries that have taken on the debt. They talk about the contribution for the local economy, so the private sector boost that they get being could be stronger, and ultimately talk about the credit risk for China from having engaged so much financially. So in the months and the years to come, I think that the BRI could benefit from addressing some of those concerns, making sure that the local economies, the private sectors are engaged, making sure that the debt is sustainable, and ensuring the governance and the transparency and the contracting and so on is as good as possible, really to maximize the benefits from this.
You turn on the TV nowadays and it's there's not a part of the world ultimately that's not being affected by extreme weather, whether that's rainfall or wildfires in all continents, remarkably.
What we're seeing now gives us a foretaste of the future we might face, blighted by climate change, which a lot of tourist sites are closing down because of this. And this is just the immediate thing that we're seeing. There's also the longer term effect on agriculture, drought, affecting especially poorer countries that depend on this. We've got the public health aspect. People, having worse health, that affects their productivity. It just creates a big negative mix. That's why we see the need to mitigate the climate emissions, and that requires global cooperation. Also, the emphasis on adaptation infrastructure to help to cope with these shocks, and really financial risk management to have insurance options when there's a shock.
And can those measures be taken without hindering growth, for example?
We've done some analysis on things like carbon pricing. The issue here is to do it in a predictable way, very credible way, and gradually raise the price of carbon. That way people can plan, and because it's credible, they can really invest in alternative clean energy. We had a chapter that came out last October on this that showed that if this is done in the right way, it can only achieve a little bit of growth, talking about 0.2 percentage points, something like this, and raise prices just very modestly. So this is something that requires global cooperation to make happen.
Just finally, this is the update for July. There'll be another one in a couple of months' time. What do you expect, what do you hope will be written in that?
Well, I hope that on inflation that there'll be some of the surprisingly low inflation prints will become more generalized, and that people, that the labor markets therefore don't have to see more unemployment, that we can have inflation lower without more unemployment, and that obviously the risks that coming from China's economy normalize, and we've got therefore grounds to even revise up our growth forecast.